Good evening, Canada. Welcome to week 8 of the Investor's Guide to Thriving for spring 2021. Well, this afternoon, Joe Biden capped market gains when he announced cap gain taxes were going up like Dogecoin. And speaking of coins, this was a huge week for crypto action, with Bitcoin declining over 10% following the Coinbase IPO, and Canada celebrated 420 by sparking the launch of 3 Ethereum ETFs from CI, Evolve, and Purpose, all claiming to be the world's first. For those of you who don't know, Bitcoin is mostly a store of value, albeit a speculative one, whereas Ethereum is actually the utility layer powering the development of Web 3.0 and is expected to be the driving force behind the decentralized finance revolution, or DeFi, as the kids are calling it. Speaking of centralized finance, the tax man cometh next week, so it's time to stop procrastinating and get that tax return filed. This evening's presentations are going to focus on ETFs and taxation and how you can generate income in the first place to pay for all those taxes. Bonds are broken, according to my business partner, Larry Berman, but that doesn't mean fixed income can't play a role in your portfolio. And if you need a hand with that portfolio, Larry is the chief investment officer of a portfolio management firm we started back in 2006 called ETF Capital Management. Today, ETFCM is part of a much larger organization called Quintessence Wealth, or Q Wealth Partners for short. We're a cutting-edge fintech company and a partnership of portfolio managers, currently managing over $2 billion and growing fast. We serve advisors and clients, plus we run some institutional mandates like the ETFs and funds of ETFs in partnership with BMO Global Asset Management. We also have U Potential, which is our fee-only financial planning company for those of you who just need some CFP-based financial planning without the investments. And Golden Girl Finance is our financial media site for women, which is also read by men. Of course, Investor's Guide to Thriving is brought to you by Prosper Experiential Media, which is the in-house marketing boutique exclusively serving Q Wealth and its partners. And we bring you the Investor's Guide to Thriving in support of childhood leukemia research at Sick Kids and Alzheimer's and dementia research at the Baycrest Foundation. Larry and I would like to thank those of you who have made donations already. And if you'd still like to make a donation, please use the links in the survey you'll receive after the event. Or visit investorsguidetothriving.com and use the links on the page. Of course, with all proceeds going to charity, your generosity and our event sponsors are the ones that make that all possible. And so a big thank you goes out to our partners in ETF education, BMO ETFs. And of course, if there were any proceeds left, they would just go to taxes. And that's why Kevin Prinz, the Prinz of ETFs, our good friend and head of ETF distribution at BMO ETFs, is here to demystify some of the tax rules around ETFs. And legal disclaimer, he's going to do all that without actually providing any tax advice. Ladies and gentlemen, here's Kevin Prinz.
Thanks so much, Jared. Always appreciate your intro there. Let's get into it. The first thing I do want to do is in the disclaimer, and Jared's right, let's put a couple of disclaimers out there because we're going to talk about taxes and give you some background around exchange traded funds and specifically around taxes. But let's be straightforward here that this session is for information purposes only. We're going to reference some particular information relative to ETFs, but it's really illustrative purposes and shouldn't be considered investment advice. And I'm going to recommend everybody, your strategies, the way you implement them, have them evaluated by professionals, and always seek advice when you have questions across the board. With that, let's get into this. And I want to start off with a little bit of information for you because we're going to talk about taxes. And BMO ETFs, we've been in the ETF industry now for a little over 11 years in the marketplace, and we have questions over the years. And one thing we've done to support the questions around exchange traded funds, because we understand that some people have been new to it, or maybe you're buying a new type of ETF for that matter. Do you have some questions about it around the exchange traded funds? No problem, and around taxes specifically. So we put together a nice little handout what to expect during tax season. It's kind of a guide and put some reference to different types of ETFs inside of it. Good news, if you want to access this, you can get access to it in 2 places. Number one, you can go to bmoetfs.com. If you look under one of our tabs on any one of our products, you'll see taxes and distributions, and then take a little close look you'll see a tax FAQ. That'll take you right to this document. The other place you can find it, and I'll reference the website at the end of the website, reference the website one more time at the end of the presentation, but the other place you can find this document is under etfmarketinsights.com. That's a registration website we use for a weekly webinar we put on. And on that, we especially put on there this document so you can quickly get access to it if you have any considerations around taxes you want to dive into deeper around it. Let's get to the next page there, Jared, with that background in place. Now, if you think about taxes, you got to think about, don't confuse distributions with performance around taxes, right? So there's really, your tax objectives shouldn't be the dominant thing when you're looking at investing across the board. I know it's hard to do. We're right in the middle of tax season. It's a key thing, but it's that tail wagging the dog thing, right? Focus specifically in your portfolio first and foremost. Think about diversification. Think about where you want your objectives across the board, and then factor in your taxes, of course. But it shouldn't be the primary. It should be a consideration, but not the primary consideration across the board. Now, when you look at taxes across the board, specifically ETFs, there's really kind of two types of taxes when you're buying an ETF and holding an ETF. So when you're buying and selling ETF, that's of course you trigger a tax or so. When you sell it, hopefully there's a gain or something like that, or it could be a loss, right? As well as for the holding period in which you have the ETF, you can have distributions, and in those distributions, of course, will be some tax factors across the board. So keep in mind, there's always two levels of when the buying and the selling, plus because it's a package product, the package product itself will have distributions, and those distributions will contain tax elements with it, inside those. Let's go to the next slide there, Jared. I always got to also ask a key question here, a difference between mutual funds and ETFs. And there's an element there when it comes to taxes too, I want to highlight, right? Because some people in this forum might be new to ETFs and coming from mutual funds, and there are some subtle differences here. So let's go through some of those subtle differences. The first and the big one is on the ETF holders, we don't know who you are, because there's that part of privacy around ETFs. It trades through the exchange. So because we don't know where you are, I'm going to recommend you as unit holders of any ETF company pay attention to the respective press releases of the ETF companies, specifically around year end, and of course when the tax factors come out too, right? Because that's going to help you better manage, better get informed around your decisions relative to taxes, right? So pay attention to that because we just don't know where you are. Now also, when you look at ETFs relative to mutual funds, there are some subtle differences to how the taxes operate. So in a mutual fund, you're constantly buying and selling from the actual mutual fund company. And when you buy and sell from the mutual fund company, that mutual fund company then buys and sells the underlying stocks, which could trigger buys or sells for the underlying, as trigger taxes to the underlying unit holders. With an exchange traded fund, what really happens for the most part, is that the ETF is sold to another person. And so the capital gains can stay within inside the structure. Now, of course, if there's rebalancing within inside that ETF or the index changes, and so that of course can trigger taxes within inside the ETF. That needs to be distributed out to all people out there. And then let's go to the next slide there, Jared. Perfect. And distributions. Now, we're going to pay out distributions based upon the calendar year and the information the tax service itself, right? So when you think about this, you got to think about different timings there across the board. So with registered timing, first of all, in February, there's going to be when we issue the calculations. Now, again, I told you a second ago, we always don't know who the holders of the ETF are. So we're going to do our calculations based upon the previous calendar year, factor up all the capital gains, the capital losses, do the calculations for the unit holders, and then we know the numbers relatively in February. Now, we, again, don't know who you are, so we then pass that information to a company called CDS, Canadian Depository of Securities. And what they do is they turn around and pass it back to the respective firm. And that firm you work with, your discount brokerage, your full service brokerage, they're going to issue the tax slips, which is also a difference between mutual funds and ETFs. Mutual funds issue tax slips directly because they know you are. In ETFs, the firm that you work with will issue that tax slip. Now, of course, everybody here should hopefully know that when you have a registered plan, you won't get a tax slip because, of course, it doesn't work that way. You don't need it because it's not how the taxes work for registered plans. But for the non-registered plans, your company that you work with, brokerage firm, will issue that documentation for you. And then also note too, depending on the firm will also do adjustments for you in your cost base too, relative to taxes base. I'll get more information for you on that in a second as we go further in the presentation. Let's go to the next slide there, Jared. Now, when you think about distributions inside, there's really two types of distributions of an ETF. Now, I think everybody understands there's the distribution paid to the investors. So a lot of ETFs have monthly pay, quarterly pay, or annual cash distributions, whatever it is. Those are paid out straight to you. And of course, the benefit of that is cash in your hand, right? There's another type of distribution that ETFs get known for. It's called a phantom distribution. Now, keep in mind that with all ETFs, there's going to be rebalancing transactions throughout the year, index changes, there could be consolidations, there could be mergers, acquisitions. There's a bunch of things that go on out there. And those could all trigger gains. They can trigger income for interest income too, for that matter. All of that, and foreign income too, I should put that in there too. All that needs to be distributed. That can't be held within inside the ETF or a mutual fund too. So that has to be distributed out. And so that is distributed out through a concept called a phantom distribution. What is a phantom distribution? Well, effectively, it is actually just the taxes distributed, the actual income or the no cash payment made. Now, I like to look at that as, okay, well, there's no cash payment made. Yes, there's a tax aspect paid out. It's a phantom. But the benefit truly is compounding, because you're going to compound on, because there's nothing being paid out, you get to compound more. But is this really an ETF dealing with the distributions or the tax aspects of inside the pool itself? Hey, Jared, let's jump to the next slide there. Because I think a lot of people want to know tax information. Where do I find more tax information? I'm an investor or an ETF. The good news is most ETF companies out there have really good tax information on their respective websites. Here's an example on BMOETFs.com. And on that website, we're showing an example of ZCN. What you can see here is just going down to the bottom box there. It says distribution for the year, and this is 2020. And what we're giving you is a total distribution at the far right, 0.76, just focusing on one number there. But then you can see the attribution of that 0.76, whether it's eligible dividends, capital gains, return of capital, forward income. That just gives you some insights on the taxes per unit. Now, of course, we don't know how many units you have, so it has to be times by units, by how many units you have, but that's the information for the 2020. Also, I'll highlight most ETF companies further give you previous tax years, because every year is going to be slightly different, could be slightly different rebalancing, there could be different activities going on, mergers, actually acquisitions again, whatever. So you can take a look at previous years distributions and the relative taxes of those on those companies' respective website too. Very good source information and very good insight to help you make a better decision going forward. Let's go to the next slide there. So we talk about tax factors themselves. Okay, what does an ETF have for various tax factors? And some examples include, Canadian dividends. Yes, if we have a company like BMO in the basket, BMO has a dividend we pay out. That dividend, of course, will then get passed through to you right? Because you're earning the dividend. If we have an ETF that pays you on a regular basis, you're getting past that. But of course, we're going to pass you the tax aspect there too. For a Canadian dividend, an ETF is exactly like the underlying, doesn't change the tax structure at all. No. So we'll pass to you through the ETF and through the firm you work with, it's going to be a tax document, the dividend. And of course, in Canada, we all know there's a dividend tax credit for Canadian securities. Bear with me. If you hold a Canadian ETF and it holds US securities, we don't change the tax underlying at all. It doesn't work that way. If the underlying is US or underlying is international, that's foreign income. It doesn't change because you're a Canadian ETF. So only Canadian underlying holdings, dividend equity paying companies would issue tax treatment that can be grossed up. In addition, of course, through an ETF, you can get capital gains. And I'll give you some examples of it, how it could trigger a capital gains. And of course, there is also your capital gains if you sell it too, but I'm talking about with inside the structure, right? And inside the structure can come from rebalancing, right? There's always rebalancing going on. There could be an index change. It could be a merger acquisition. All those could lead to various capital gains. Now, outside of equity-based structures in Canada, you can get fixed income, right? And fixed income will pay interest income. And then I'll also highlight foreign income too, right? So if you're having US holdings, international holdings, that'll be foreign income. And again, one more time, just because this Canadian ETF won't change that. And we all know that foreign income is just treated like ordinary income, and ordinary income is the same thing as interest income across the board. Now, going to tax factors here, one more slide, bear with me. Jumping ahead there, sorry, go back there a second, I'm sorry. Perfect. Foreign income taxes paid. Perfect. Great. One thing I do want to highlight in foreign income tax paid, and I'll show you a second later on, is that if you do have foreign income taxes paid, there could be like a withholding tax with inside a structure, right? If you do have a foreign income tax paid, there is a credit for outside the registered plan that can be used to offset other income earned, right? And the other thing you can get inside that tax slip you're going to get, you could get return of capital, right? And return of capital can be from a number of different reasons across the board, and I'll get into that. But one thing I do want to highlight here is what happens on the adjustment basis too, right? Because when you are holding an ETF and you hold an ETF for a longer period of time, you're going to want to have different adjustments to your cost base from time to time. What I mean by that is, let's say, for example, return of capital, you get a piece of that. Now, if you get a return of capital to your things, this will want you to adjust the cost base to factor in that you had a little bit of return of capital. Same thing for capital gains. If you got a capital gain paid out to you, you would want to adjust your cost base up, for example, to factor in that you already prepaid some tax. Now, a lot of firms out there actually do that adjustment to the cost base for you, but pay attention to that because that's a key aspect. Not all firms do that, and not all firms do it the same way. Some firms do it for all registered, non-registered plans. I'm not sure why registered, but they do it all across the board. And some places just do it for non-registered. Shouldn't make it, it doesn't make it, it's just an adjustment, but pay attention that your firm is doing an adjustment. If they're not doing an adjustment, key for you to keep in mind that adjustment too, because if you've paid taxes, a capital gain, then you want to make sure you're not paying that taxes again in the future. Key thing for you and your account to think about. All right, let's move to the next slide. Perfect, capital gains. What's triggering this? I mentioned a few times already. You could have performance with inside the underlying if we sell it off and you're rebalancing, or maybe investment objective, not change, but the investment, the underlying no longer fits within some of the criteria of the ETF because it's a certain factor, so it gets removed. There could be a corporate action that would trigger a capital gain. This is a merger or acquisition, of course, and then I already mentioned a few times, a trigger capital gain could be like a portfolio rebalancing. All this will happen inside your ETFs on a regular basis, so that's where your capital gains are mostly coming from across the board. Let's go to the next slide. Perfect. Now, the other one we hear about from time to time is return of capital, nicknamed ROC if you don't know that terminology across the board. Now, one key thing to think about when you hear about the words ROC or return of capital is you want to understand what could trigger return of capital, or if it's good or bad ROC is what I like to say, right? So, bad ROC is when a company is paying, it doesn't have a sustainable income to it, right? So they're paying out more effectively than they're earning across the board, right? If they're paying out what they're earning, then the ROC could actually turn out to be a good ROC, because it's giving it a little bit of a classification of your underlying yield being paid out to you as return of capital. That turns out to be a benefit for a short period. So keep in mind when you're looking at various ETFs out there, take a look underneath the hood and take a look to see if the underlying is generating the yield to pay for that income. That's the key thing to look across the board. I can tell you that BMO ETFs focuses on a sustainable yield across the board. So we're factoring that in. You will see return of capital from ETFs from time to time. And you could see that for a number of different reasons out there. ETF growth is one of those reasons. You could also see it because there's a loss within inside the portfolio. For example, on a covered call where the underlying appreciates beyond the limit of the option itself, so it goes in the money, right? That could trigger a little bit of loss. Even though it's up, it could trigger an offsetting loss. So there could be good reasons for return of capital in there. It's not always because you got your money back to you, but it is up to you to take a look underneath the hood of respective ETFs, ask the ETF providers what's generating that respective return of capital, and get comfortable with that in your investment decisions. Let's jump to the next slide. And of course, I mentioned already, you could get return of capital with inside. For cover call ETFs, you could get return of capital from the going in the money of the option aspect, right? But again, make sure you're looking underneath the hood for what's generating the yield. In this case, a lot of cases for cover calls, the premiums that we're earning, that's that derivative piece, right? That's going to be a capital gains. Those are going to be combined with losses inside the portfolio, and the balance will be paid out for you. All right. Let's go to the next slide. Currency hedging. This is another aspect you could get from an ETF. So if you're buying an ETF that has a currency hedge, understand that that currency hedge itself is a derivative, right? And we do these on a monthly basis and roll on these contracts on a regular basis. That itself can trigger a capital gain if that goes in the money, right? So that could be another source of capital gains that needs to be distributed out to the respective holders. It also can trigger a loss too if it goes below, right? So factor in that currency hedging can be giving distributed capital gains. And then one other key factor for tax considerations across the board I'm going to highlight is there's withholding taxes. I mentioned the bat. That's something more to do with international as well as U.S. And then there could be benefits from like a T1135 if you're not whole, because if you take if a Canadian is a shell, the ETF is a shell itself. If it holds foreign, it effectively says you don't have to fill out the T1135 documents because it becomes a Canadian property. And last but not least, of course, the U.S. estate taxes, the shell of the Canadian ETF helps protect the underlying assets from the potential of a U.S. estate tax across up there. Let's go to the next slide. This is your tax document. Hopefully you've seen the T3s. I'm just highlighting here based upon some of the things I talked about here, some of the key boxes you're going to see in these things: the return of capital, the foreign income, the dividends paid, foreign non-business income, and capital gains. These are some of the sums that reference back into the document to help you guide yourself when you're looking at the respective documents. Because sometimes you see box 42 and don't even know what that is. That's your return of capital piece, or your box 34. So helps you a little understand what's on there. That's also on that slip, also on the what to expect during tax season document. So a good document to help give you some background and some understanding in regards to taxes around exchange traded funds. Subtle differences, but important to understand them as a part of your investment decision, but shouldn't be the key part of your investment decision. And what I'd like to do is I'd like to invite everybody to come and join us tomorrow at our Market Insights webinar. Every Friday, we have a session on a different topic. Tomorrow, we're going to actually talk about options. So hopefully you can come and join us on that. And I'll also note the next week we're going to talk about NASDAQ. But every week we spend half an hour trying to provide good education around exchange traded funds. We actually had a session about 6 weeks ago in regards towards taxes too. So you want some more information, take a look at it on YouTube. We have it there for you. And one last time, if you're looking for that tax document I just mentioned before, what to expect during tax season, you can also find it on etfmarketinsights.com. With that, I'll pass it over to you, Larry. Thanks for having us on the show.
Here
And
we
Larry,
go.
I can't hear. Good.
Okay, here we go. I am unmuted. So Kev, thanks a lot for that. Again, thanks to BMO for being such a great partner and sponsor of these events, and a very special shout out to a very special birthday boy, Kevin, who's celebrating tomorrow. A very big birthday. So happy birthday, Kev. Thanks for sharing your night with us. And on my favorite subject, and taxes, I just love taxes. I'm so excited when the headline hit that Joe Biden was going to look to raise capital gains tax. The first thought in my head is, opens the door for Trudeau to do the same. And isn't that great that we all get to pay more tax? It's my favorite thing next to getting a tooth filled without painkiller. It really, it's so exciting. Anyways, obviously you can tell I'm joking there. Everyone should, as a matter of course, try to minimize their taxes wherever possible. Okay. So I'm not going to talk about taxes, but I'm going to talk about one of the impacts of taxes, and that's government budgets tonight, and the bulging budgets we're seeing. And I thought this would be a great topic this week, given the Canadian budget that came out for the first time in a couple years. What's happening with interest rates, and the fact that it's tax season. So it all kinds of lines up. It was interesting to see the market response today. So here's how the algorithms are interacting with markets. And I often get these questions: how can we compete against, the algos and the fast money traders? And the answer is you can't. The news story came out, and I got another news story I'm going to show you tonight in the presentation as well. But the news story came out not on Bloomberg or Reuters, but on a secondary service. And the market didn't have a response to Biden's headline. But then Bloomberg reprinted it, and the algos read the headlines that come off the Bloomberg terminals and Reuters and so forth. And then the markets sold off aggressively. So it was quite interesting to see that behavior, that on the initial headline, nothing happened, but it was when the headline hit the high frequency terminals that money started moving aggressively. So I've said for a long time, governments are broke, taxes are going up. I'm not advocating for those policies, but that's the reality of the world we live in. So we're going to look at government budgets tonight. The high caution alert remains on our ProEyes indicators. Again, if you haven't followed that, please, have a look at it. It's really a very, very, if I can pat myself on the back for just a sec, elegant way of understanding all the different factors that come into risk return analysis, certainly for me at a macro level, where I look at the valuation of markets. I look at the influences on the business cycle, growth, inflation, interest rates, etc. Are they moving up? Are they moving down? What's the yield curve telling us? And then it's the technical stuff that I'm more known for, the ups and downs, the sentiment, the seasonality, the volatility, the trends, and so forth. So it's great one-stop shopping for that. We have a little narrative for all the indicators. So, you know, the current readings as of last week are very high. I did a quick sneak peek today after the close. There's really no material difference this week. The markets have been spinning a little bit, and because of that, some things are up a bit, some things are down, but overall we're still in the cautionary range. And as we looked at last week, what happens historically over the next couple of months, 3-month time frame I'm looking at here, to the drawdown. So from where we've been to where we might trough out, and that number based on where we are today, when the composite reading is 80 or more, which is basically where we are, which is seen less than 1% of the time historically. So again, once or twice a year, you get this kind of cautionary that you get on average within 3 months a drawdown that will average 11.3% and has a median of 7.5. So again, when Larry's on BNN historically, and he says, you know, 5 to 10% correction isn't out of the scope of possibility. And I remember years ago I had said this, and the market went down about 5 and a bit percent, and then I think Bernanke at the time did more QE, and the markets ripped higher. And this gentleman stopped me on an airplane. I was sitting next to him on a trip to Calgary, I think it was, and you know, chewed my ear off basically because you know, he said, well, you were wrong. You said there was going to be a 5 or 10% correction. I sold all my holdings. I said, well, sir, there's a 5 to 10% correction pretty much once a year. It's like, if you go back and look at volatility, so it's normal. So why would you sell everything if something normal is going to happen, right? So I want to put that risk return kind of in context here. Now, what history tells us is that when valuations are extreme, which they are now, that those corrections can be a little bit more severe. And you can see very clearly that within a 3-month period, there's all kinds of dots over the last 20 years where we've had more serious corrections. Obviously, a lot of them were the great financial crisis. A lot of them were COVID last year. And if you go back to the early post 9/11 kind of period in there, you obviously had some bigger shorter term drawdowns as well. So, but we're in a high risk area, and now's not the time to take a lot of risk in your portfolios. And so historically, what that would mean, as we talked about last week, was having more balance in your portfolio. And so in 1990, the Nobel Prize was given to these 3 gentlemen, Merkowitz, Miller, and Sharp, Markowitz, not Merkowitz, for their work that started in the 1950s, actually, for looking at risk and return together, and they developed this concept called the efficient frontier. And so if you think about a portfolio that would be all fixed income, you've got a certain degree of risk, volatility in your portfolio, and you have a return on average that's lower because bond risk is generally, compared to stock risk, a lot lower, and so your expected return is lower. 100% stock portfolio, because it's riskier, is going to have more of an expected return, but more volatility, more standard deviation of your returns. And what they were able to show through this methodology was that you could optimize the ideal type of portfolio. In other words, you can either reduce risk or increase return, and ideally both. And that became the most efficient portfolio, or where what's called the capital asset pricing line meets the efficient frontier. So you could have a 100% bond portfolio and have a certain degree of volatility, But when you start adding equities, you can actually increase your return and lower your risk. And this is where the idea of balanced portfolios came from. Again, the original work here was done in the 1950s, and it wasn't until 1990 when the Nobel Committee recognized it. But this is the basis of what is taught in business schools in terms of understanding risk and return. The problem is, as brilliant as these gentlemen are, and as worthy as their work are, because bond yields don't yield you anything anymore, this is all nonsense. The balance that you're still going to get balance, but you're not going to get that yield. So bonds are not going to do what they've done historically. So what I did was I found this long-term chart taking US interest rates and the various different things that moved markets over basically since the U.S. independence, and goes back to the creation of the first debt instrument, which was around 1787, if my memory is correct. And so the tracking of this started, in this case, in 1790. And you can see long-term interest rates. So they use approximately a 10-year rate. And you can see it's gone up and down. Now, these are annual numbers, not intra-month numbers, because I know the US 10-year rate got to a little over 16%. And the reason I know that is because in 1981, I was 16, and I remember a Government of Canada bond with a 16% coupon. Anyways, so that was, and then for the last 40 years has been falling. So then I currently blew up on the right side, and it's a chart I've shown on BNN before. The yield to worst of the entire world bond index. So yield to worst is like yield to maturity, except it factors in the callability or the optionality sometimes embedded in a bond, where you can be converted to a stock. So it's a yield to the worst outcome, meaning when the bond is called. So it's the same as, pretty much the same as yield to maturity. So the entire world of fixed income, investment grade, not including junk bonds, 1.1%. And then the Canadian bond market, 1.58. And when you look at inflation, I don't think there's anybody really on the planet who doesn't believe that inflation's running somewhere north of 2, even though the official numbers are less than that. But we all have our own personal, inflation rates, depend on what we spend ourselves. But collectively, what the government tells us is those numbers are probably in the mid ones right now. And what the central banks are wanting more of is more inflation. They want to see that inflation number go above 2 and stay there for some period of time. Tiff Macklin reiterated that again this week. Powell has said it many times. We hear it from Christine Lagarde at the European Central Bank. All the central bankers now want more inflation. So what that means is the entire world of fixed income after inflation has a negative return. And that's why bonds are broken. However, there's still the concept of interest rate sensitivity, right? And so the US government bond, 30-year, that trades right now at 2.22% real time, right now, is the highest yielding government debt, quality government debt in the world. It's got a higher yield than Spain, than Italy, than Greece. How is that even possible? Because those economies are in far worse shape. They're not the biggest economies in the world. They're not the reserve currency of the world. So there's actually some value in US treasuries relative to other places in the world that actually may have negative yields. So it's the entire world of fixed income is upside down on its head, and it's with a purpose. because it's the amount of debt that keeps growing and growing and growing, and that stems from budgets and governments, and we got the update, and I'm going to talk a little bit more about that. But the glue that's holding this all together now from bond yields spiking up, because the amount of supply of debt that needs to come in the months, the years, and the decades ahead is colossal. And we're going to look at some pictures there and get some sense of what all this is. But for now, it's the Fed balance sheet. So the balance sheet increased in the years after the Great Recession, 12 years ago now, and then stabilized for a number of years, 2014, 2015, 2016. And then the Fed got brave and they said, economy's taking off here. President Trump just did a bunch of stimulus and we're going to start raising interest rates. And at the same time, they nudged up the overnight rate. We're going to start reducing the size of the balance sheet, because this was only ever meant to be a temporary fix to get us through that extraordinary period where the world fell apart because of the leverage in US housing, right? That was that one. This one, obviously, a global pandemic. So here we go. And because of the Trump tax bill, we got this massive speculation in 2017. Taxes are going to be cut. Stimulus, stimulus, stimulus. Markets take off to the upside. They get extreme. You go back and look at our pro eyes, you'll see the extremeness of the indicator, then. And then the volatility market blew up and we got a correction process in the first few months of 2018. Then things stabilized and you got some friendly words from the central banks and off we go again. And earnings were good and the tax cuts were coming in and companies were happy and earnings were growing and the market starts going again. And then the Fed starts nudging interest rates up again, because that's what they do. They take the punch bowl away because inflation pressures pick up and they've got to cool them down. Okay? That's what they do. Every recession in the last 70 years has been caused by the Fed taking the punch bowl away. And it's something we've talked about for years in all our seminars and so forth. So fourth quarter of 2018, after the Fed raises rates only 250 basis points. Historically, before the recession hit, the Fed would have raised interest rates 525 basis points. That's the historical median. They got 250 into it, and they raised rates in December of 2018, a week before Christmas. And in the press conference, one of the reporters asked Powell about the balance sheet runoff, and he said, we're on autopilot. And the algos don't like autopilot. Nobody likes autopilot. Tesla doesn't like autopilot. The markets collapsed. And then the Fed had and Jerome Powell a few days later, remember at the same time, Trump was Mr. Tariff Man, right? He was tweeting about tariffs with China. The next week, Powell comes out and says, maybe we're not going to be raising interest rates anymore. And markets came back. They came back with a vengeance. And then they started to stumble again in the middle of 2019. The balance sheet kept running off. And what did the Fed have to do? They had to start QE again. What happened? The markets goosed into the end of 2019. The markets love that the Fed is buying the bonds. And then COVID hit. And then the world changed. And the Fed is still using extraordinary support for financial markets. And we're at all-time highs. Who would have guessed it, with the worst economic shock to hit the world? And so, don't fight the Fed and everything else. I learned the lesson last year, because to me, this is gross mismanagement of the world. But this is the world we live in, and QE is the glue. So The next big risk for markets is when the Fed pulls back from QE, and when we have that taper risk. So what we're going to see, so May 3rd, Janet Yellen makes another announcement of what the funding schedule is going to be for the back half of the year. And she has a couple $100 billion still to work with in the Treasury General account that she can run down a bit more, which would push the need for more funding back a few months. But it's inevitable that the US Treasury needs to raise about $2 trillion to pay for all the largesse that we know about, not including whatever comes in the next stimulus bill that Biden's trying to get pushed through now. So we've got a lot of bond supply coming, and right now the Fed is buying about $1 trillion. The Bank of Canada was buying $5 billion a week, 20 billion a month, 240 billion a year, so over the last year. And a couple meetings ago, they cut that to 4 billion. And yesterday, they cut it to 3 billion. I got some interesting things on that to show you. So this is kind of the world we live in today, and it's being held together by glue. So when it comes to that balanced portfolio and asset allocation, we showed this last week. I showed this on Berman's call this week. When I look at the middle of that chart to the bottom left, the 60-40 area there, you can see it if you look at 0 in terms of expected real return after inflation, and you look just before 10%, that 60-40 balanced portfolio after inflation is going to have an average return of negative for the next 10 years annually on average. Now, some years will be up, some years will be down, but that's the expectation based on where bond yields are today, inflation expectations are over the next decade, and where the valuation of equities are today. The point I want to make also on this graphic is international markets, Europe, Australasia, the Far East. So look around 4% nominal, so that's real. So add inflation of 2 or 3, you get 7. So that's okay. Emerging markets, it's around 5, but there's more standard deviation. So there's opportunity out there. There's something to own, but the value is not in the US market. It's not in the Canadian market. The value is international. Okay, so budget week. So it's the math of issuance relative to what the market can handle. So here's the math. So there's 101 billion of government of Canada bonds maturing this fiscal year. So that implies a net issuance of 185 billion for the 21-22 fiscal year. And that compared to last year, 278 billion. However, because the Bank of Canada bought 240 billion worth, the net issuance last year was actually just 13 billion. So the net new supply out of all that Trudeau spent, and a lot of it he had to spend, didn't have a choice, so that I'm not faulting him for that. The Bank of Canada monetized, put on the balance sheet. Those bonds didn't have an impact on the yield market. But this year, the net supply, Bank of Canada is only going to buy about half of what they bought last year. That's the estimate based on what we think they're telling us now, based on the update from Tiff Macklem yesterday. That implies net bond supply, so issuance, of 61 billion, which is considerably more than the issuance last year. Just so you understand what that means, the Canadian economy is about $2 trillion. So issuing 61 billion of debt is approximately 3% of GDP. Okay, and it's that bond supply, that 60 billion that needs to go into the bond market. And if it didn't go into the bond market, it would probably go into the equity market. It would go somewhere else. But it's got to go into the bond market to fund that. And if they can't fund it, then interest rates are going to go up until it gets to a level where they can fund it. Right? There's going to be an interest rate that attracts that debt. And if rates are too low, who's going to buy the debt? And that's where we have a problem. Okay? And that's where central banks are actually going to have to step up. So if you look at the what the Bank of Canada is issuing, okay, so historically or last year, 2-year bonds, 3-year bonds, 5-year bonds, 10-year bonds, total issuance, and then that's gross, and then net of what was refunding and to rebuy those securities, etc. So what they've done is they're increasing. Okay, so they're decreasing the 2-year for the next fiscal year, decreasing the 3-year, decreasing the 5-year. They're increasing the 10-year and keeping the 30 years. So they're extending the maturity. So what the government is doing is issuing longer term debt because rates are low. So it kind of makes sense to lock in the low rates. So why would you want to be buying longer bonds if the government's selling those, right? So just think about that. Let it stew around and marinate for a little bit. So they're extending their terming out basically in terms of what they compare to what they've done historically. So that should put upward pressure on interest rates, longer term rates. That in turn lifts the curve, steepens the curve. So that's good for bank profitability. But at the end of the day, if rates go too high, mortgages have a problem and so forth. And that's the real economy impact. So the Bank of Canada was debated amongst economists. The Bank of Canada yesterday at 10 a.m. was not expected. Some did, some didn't. But in general, the expectation was the Bank of Canada was not going to reduce QE. Okay? So they were doing $4 billion a week. This news story came out, the one on the right here, by MT Newswire. So MT Newswires is not like a mainline newswire. It's kind of a paid for service. There was a fake story. Folks, this is real. There was a fake story put out on the MT Newswires. And it was put out maybe 5 minutes before Bloomberg picked it up. And Bloomberg picked it up and then put it on the terminal. So that white line, right? So the vertical white line that I have there was at 9:42 when this story hit 9:41:42. And it said that they weren't going to taper the QE. So the Canadian dollar started selling off. And it spiked a little bit, and you can see the chart there. And then at 10 a.m., the real headlines hit. It says Bank of Canada reduces weekly asset purchases $3 billion. And then the Canadian dollar rallied. So the tighter the central bank, the stronger the currency. The looser the central bank, the weaker the currency, right? So when the Canadian dollar exchange rate goes up, it's a weaker Canadian dollar. And when it goes down, it's a stronger Canadian dollar because it trades in the marketplace inverse to how we think about it. And just for, 80 cents is 125, just for people's orientation there a little bit. So we've seen a couple of interesting things happen with how trading works. And, the average person shouldn't do that. But I thought this was very interesting yesterday on how it all played out and how sometimes you can't trust what you see because there is fake news. So that was Canada. So let's look at the US. Because here's where the problem is. This is the reserve currency of the world. This is the biggest economy in the world still today, and may not be in 10 years, but still today. The Congressional Budget Office is the organization, nonpartisan, that looks at the budget and estimates for the next 10, 20, 30 years what the outlook is, based on the policies that they understand and they know. Okay? So in the most recent update that came out in March, they update this pretty much every month. This did not include the 1.9 trillion because at the time it wasn't passed yet. Okay? So the estimate for 2021 was that the deficit would be 10.3% of GDP, which would be now it's going to be bigger because of the more. And it would be the second biggest since World War II, exceeded only by last year. So in their projections, the out to 2031, they're basically saying that it's going to be relatively stable. I don't believe that for a minute, but as they project out for the next number of decades, you can see that the percentage of debt that's owned to domestic, so Americans, whether they're pension funds or whatever, internal, not external debt, internal, is projected to be 200% of GDP. And this projection is based on their known costs for Medicare, based on inflation, et cetera, all the social benefits, what they think they're going to need to pay federal employees for salaries, so all the entitlements and all the discretionary spending. This is where we're headed, folks. It's catastrophic. And they only want to do more, right? So when you look at it from this perspective, this is why interest rates and inflation, and my belief that the Fed can never stop doing QE and will only have to increase it. In other words, modern monetary theory, we're going into that world, is because the primary deficit that's going to basically stick at around 5% of GDP, right? So US economy, 20 trillion, 5% of GDP, $1 trillion. That's based on what we know. As the economy grows at 2 or 3 and the deficit's 5, the size of the deficit relative to the economy keeps getting bigger and bigger and bigger and bigger. And that's what you saw in the other graph. If interest rates go up, which they expect, the net interest cost starts compounding in a very, very ugly way, where your biggest cost that's going to be, so if your deficit is double the size of the economy, right? So the economy, so let's say the economy in 2051 is double the size at $40 trillion, okay? And your deficit at that point is $80 trillion. And interest rates are 1%. It's $800 billion in interest rate costs. So what they're suggesting here is the interest rate cost itself is going to be about, looks like by then, 6-7% of GDP, right? So just do the math, walk through the math with me here. If the economy is 40 trillion and the interest rate cost is 7%, 3 trillion approximately, a little less than that in terms of interest cost. I'm crying here, folks, how now Canada is in a much better shape despite all the bashing of the budgets recently than the US. The US outlook is catastrophic. the math here is bad. Now, if Canada doesn't do anything about it, we're heading there too, because we have the same bad demographics and so forth. And the biggest costs are healthcare and social benefits as people live longer, by far. And then the interest rate costs. We can't afford interest rates to go up if we can't manage our debt. It just won't work, folks. So that's the projection. This is the government's own numbers. This is the government budget people who are nonpartisan telling Americans what it's going to be. Nobody cares, right? Well, some people like me care, but nobody cares. And so party on, folks. But one day, whenever that is, this is going to be just a big problem. But the whole world has this problem. The debt is everywhere. And so bonds are broken. Okay, so if central banks want more inflation, what are we going to do? Right? So what's the best hedge? Because when you have a when you have a twin deficit, when you have bad fiscal policy, when people don't want your currency, so your currency's depreciating. Now, Europe's in a worse state than the US, and so are a lot of other places. So the US dollar is still going to be the reserve currency of the world. But China, make no mistake, wants reserve currency status, and they're going to do everything they possibly can from a geopolitical perspective to gain that in the coming decades. Make no mistake about that. Now, I really hope we don't go hot war over Taiwan and everything else. But Russia, pulled back their troops from the Ukrainian border. They tested, they're testing. So China, at some point in the next couple of years, I think before the US midterms, is going to do something with Taiwan. And I listen to these geopolitical thinkers, and nobody wants a hot war, but we'll see. So, in the world where currencies are going to have to be debased because of the interest rate problem, and that means more QE and more QE and more QE, inflation is going to come. Now, we've talked about inflation, and we talked about wages and inequality, and part of the tax hikes for Biden, minimum wages up, all those things are coming. That's going to be a big headwind for asset prices in general and corporate margins, especially if taxes are going to be rising. So, we've got a lot of tailwinds over the last 40 years behind us, and those tailwinds just aren't in front of us. But the biggest tailwind in front of us that I'm still wildly bullish about is technology and how deflationary technology is. So, it'll be interesting to see how all those things play out. But the best hedge for currency debasement and inflation are real assets. And that is gold, and it's real estate, it's land, it's stuff that you can touch and hold and feel. Now, cryptocurrencies are getting thrown into the hopper there, and you can't touch or feel those things. To me, they're just another asset. It is a commodity, it's tradable, and from that perspective right now, it seems attractive to people. But I think it's going to end really badly. But that's me, and I'm in the minority on that right now. But so a couple of ETF ideas for you all tonight. But guys, ETFs are not the best way to do these hedges and to play this. There are a couple of ETFs. COMT, if you're looking at a broad basket of commodities, is probably one of the best that manages the risk of holding futures contracts, because ultimately commodities are futures outside of base metals, not base metals, precious metals, where you're literally holding bullion. But in the most cases of these commodity exposures, you're holding futures contracts, and that could be futures of crude oil and wheat and coffee and crude oil and and soybeans and copper and zinc and nickel and etc. And then there's real assets like REITs. But the experience in the public markets and the volatility of all these asset classes during a market correction doesn't protect you one iota. It's very volatile. Now it comes back as markets come back, as asset prices do that. But the volatility is no different than equities. So in a bad market, ETFs aren't going to protect you, right? They're just not. So private equity and private credit markets, to me, are a growing area of extreme interest, and why we launched for our clients at ETF Capital Management private equity and private credit funds, because the volatility that you experience during bad periods are minimal. They're not zero, they're minimal, kind of like holding a short-term bond, but you're able to generate yields in the 6, 7, 8% range. Hands up, folks, who wants 6, 7, 8% with low volatility, right? There you go. There's your answer. So they're not in ETF formats. As soon as private equity becomes public, you have public market volatility. So unfortunately, the challenge in this space is liquidity. Sometimes in a private equity fund, your money's locked up for 5 to 7 to 10 years. You can't get it out. And then you buy one deal and you're not diversified, right? So the way to get diversification and many different types of exposures, different types of credit managers. So we started a fund that does that for our clients. And if that's something of interest to you, I would encourage you guys to reach out. But you also have to fall under these high net worth rules, meaning the minimum investments for each one needs to be generally about 150,000. So in order to diversify yourself away, $1 million, $2 million type portfolios, so that you can buy 5 or 10 of these different types of offerings and diversify yourself away. So if you have very large portfolios, then you can do some of these things yourself. But for the average investor, it becomes very difficult. But this is a growing area of interest, and I think is one of these solutions that will help you deal with not only market volatility issues for people, but inflation concerns as well, because you don't get the yields that are in the public market, you get the yields that are in the private market, and they're considerably more attractive than public debt at this point, whether that's good corporates or not. High yield debt that trades with the volatility of equities is only in the 4% range, and those credit spreads, as I showed on Berman's call this week, have never been tighter. That aspect of the credit market aspect of my business cycle part of my ProEyes indicator is the one that is a higher risk at the moment. And again, I encourage people to go have a look at that. So that's it for tonight. Into the Q&A part of the show, evening, event, webinar, whatever you want to call it. Okay, so what's my opinion on the Swiss franc, and are there any currency ETFs you would recommend? So let's have a look here. Here's actually a favorite currency of mine is gold bullion. So, when I'm looking at a chart, so you can look at the last year and you get this picture and you say, ooh, that's bearish. And then you can blow it up one time frame and say, huh, that's kind of bullish looking. And then you can blow it up a lot bigger time frame. To something that looks like that and say, wow, that's a big up, a really big base, a breakout, another base coming. The odds of another rally here are pretty high. So it really depends on your time frame and your perspective. Right now, gold is one of my favorite currencies. But when we look at the Swiss franc, so FX, what is the Swiss franc? FXF is the ETF that trades in the US and is the Swiss franc. So this is going to trade at a premium to the euro, and it'll move up and down with the dollar index and so forth. And if you look at it, it doesn't look materially different. So again, time frame. So in the context of the last 5-7 years here, you know, big base, and you look at it from that perspective, and then you kind of say, where is it going here? You know, when someone wants to sell the U.S. dollar because they don't want it, the Swiss franc is a good alternative flight to safety. So from that perspective, in a risk off, it's attractive relative to Canadian and U.S. dollars for sure. So this ETF would be very interesting, you know, in a risk off event. But if I blow up and zoom in on how that all played out, that's what happened to the Swiss franc, right? So temporarily it spiked and then it corrected. So to me, the Swiss franc's a trading vehicle, good for risk off environments. Do I see it trending higher? Well, the question is, if you sell dollars, where are you going to put those dollars? And the Swiss economy isn't big enough to handle all those dollars. Europe, I would argue, is in worse shape than the US from a fiscal standpoint, from a growth standpoint, but much better valuation in terms of their markets, as we saw earlier tonight in that graphic. So there's elements there for sure. And so do you want to play those things? Well, you know, here, you know, you could play the Australian dollar, FXA, if you were, you know, bullish on commodities and bullish on China, you could be bullish on FXA as a trending currency, but it's going to correlate very highly with the Canadian dollar. So it would be a way to be in the US dollar, but in the Canadian dollar. But if the Canadian dollar's rising, so let's look at this, not in US dollar terms, but in Canadian dollar terms. And then all of a sudden the chart is not as attractive as it was in US dollar terms. So anyway, some of the things to think about. Great question. If the inflation scenario that everyone's talking about doesn't happen, would that be worse for the Canadian dollar than the US? If you think the Canadian dollar is overvalued, what would you invest in to take advantage of the situation? So again, time frame is key here. If the Fed does the right things and the Bank of Canada does the right things, and the reflation, so Fed doing the right things means they step on the gas and do more QE when all that bond supply comes. If they don't, we'll get a risk off in equity markets, which means the US dollar should rally relative to the Canadian dollar, and generally commodities should sell off a little bit. So putting your money in a defensive holding in the US or an inverse US market exposure would be a way to get something that would go up. But often US long bonds are the way to play it. And I've said TLT before. Now, I just got through crucifying fixed income. It doesn't mean you can't trade it. It's just not investable at the moment. TLT is the ETF that I would use, you know, in that scenario. So let's look at TLT here, and let's look at a chart. Let me blow this up a bit so it's bigger for everybody. So obviously, kind of looks like the gold chart the last 6 months, doesn't it? So I'm looking at a couple different perspectives here on TLT. So one of the trends I'm looking at is this one, obviously as a bearish trend here. Now we came out of the bottom end, and now we should theoretically find resistance around the lower end of this channel. So that's one of the things I'm looking at right now. But then if we change time frames and we zoom in and we kind of say, well, let's look at this time frame. Now we kind of have this picture going on. And this picture, counter to that trend, has got that going on. So I kind of look at this, and I kind of look at the next few months, and I know May 3rd is a big day for the Treasury. So I can project that May 3rd up right there and say, 142-ish is interesting here. Now, at the end of February in the rebalancing, we got a spike up to about 143 in TLT. So that could be, in the next couple of weeks here, a pretty interesting area up in here. Now, for me, for my bond exposure, I did not think US 10s were going to go through 1.25 and US longs were going to go through 2%. So when we look at what these levels are, so now I'm going to look at a yield chart. So I'm going to convert this to a yield chart. So the US long bond. So remember, we're now looking at it upside down, right? So I didn't think we were going to break through 2, and we did. That spike in TLT, the end of February, US long bonds got to 210. So to me, the 210, 215 area is pretty critical. So right now we're sitting at 223. When I looked at it an hour ago, it was at 222. So it does move around here, as you can see. Now, I have a position in my BMO Tactical Balance Fund. I own 200,000 TLTs, and it's about 10% of the portfolio, okay? I sold today 50,000, so a quarter of my position, right around here. So the average sale price was 140.27, I think. Sold 50,000 today at an average price. Now, if I bring this trend channel up and look at it from this perspective, so there's one trend channel, and then within that, I kind of have another one here where there's a bit tighter band of support and resistance. So isn't that neat how it kind of keeps bouncing off these levels? So if I thought we were going to have a bearish sell-off, my next kind of buy target would be up around 228. We were only there a couple days ago, like 48 hours ago, and we had a spike overnight to 232. So we are talking about tight trading ranges here. So the 50,000 that I sold today, if we go back to 227, kind of where the low yield of today was, or the high yield of today was, I'd be looking to buy that position back in. So let me flip back again to TLT here. And let's look at that on a intraday basis for the last week. So that bond yield chart trades 24 hours, right? That's a 24-hour chart. This is a market hours chart, 9:30 to 4. So the high price wise, when we saw yield spike, it got to about 141. So I sold against the resistance earlier today. I was a seller up here. We had a sell-off, and actually around this support. What I sold here in the morning, I bought back in here. And as we got back to those ranges, I sold the rest of my 50,000 shares. So, you know, back and forth, moving around, bonds can be used as a tool. Now, I don't know who asked this question or who you are, but I think it's one thing that we can use to play defense. But you have to be very active. I don't think you can sit passively, because the big trend here, again, let's look at the big trend in interest rates and inflation. Sorry. The bigger term trend here, this is bearish. Okay, and while we're at some support here, as you can clearly see, that if the Fed does not buy all those excess bonds that are coming later this year, this breaks and we start to look at these levels, right? So 111, right? So that is pre-COVID for sure, but going back to where bond yields were freaking out a little bit in 2018, right? So again, let me change this to a yield chart. And let's go back into 2018 and say, what were those yields? So this is a yield where the US long bond got close to 3.5%. Wow. What would that do to mortgages, right? If the US 10-year got to those levels and the Fed did nothing about it, the US 10-year would be in the low threes. I can tell you right now, people who are tight on their mortgages are going to have a problem paying. The refi market, the housing boom we're seeing now goes cold. The economy shuts down. The Fed has to step in with more QE. That is the debt trap we're in. The economy's leveraged on low rates. We can't afford interest rates to go higher. So there's a lot of interesting things here. The bond market is a tool. You just got to know how to use it. I don't think you can be passive with it any longer. I own a large amount of preferred shares, pipelines, utilities, oil companies. What do you think the risk is going forward with preferred shares? Well, in the case of pipelines, utilities, and oil companies, it's the commodity market. And so for the next few years, we're probably okay. But we are in an environment where the world is going green, and less and less and less is carbon based, and everything you kind of have here is carbon based. Now, utilities are okay if you're energy producers. Pipeline utilities, natural gas is going to be around for a long, long, long time. Oil sands, best days are behind us. 20 years from now, are we going to still be mining oil in the oil sands? Yes, absolutely. It's probably a fraction of what we're doing today, but so that's the longer term dynamic. And so in the short run, I think we're okay. But these things also have a lot of capital, a lot of debt. They have preferreds, but they have a lot of debt. And if interest rates go up, margins get hurt. They're very interest rate sensitive sectors. So there's a lot of factors. If we're rising because of real commodity inflation and their revenues are going up because of it, there's an offset. So the answer is, what's the scenario? And these are very good questions. I think we're okay short term. Long term, they're tradable, they're not investable. And I would increasingly, and on the private side, we're seeing a lot more push. I'm in a couple projects now in our private funds where we're funding renewables and wind farms and things like that. I tweeted today for Earth Day. Happy Earth Day, everyone, by the way. I tweeted today that I believe hydrogen is a big part of the future. I actually wrote puts today on Plug. Let me quickly show you that trade. So here's Plug. It's one of Kathy Wood's favorite names, and it's a big component of all the green energy ETFs, and we look at, you know, the chart and we say, OMG, right? So how do you buy this? Where do you buy this? Where's the bottom? You know, if we look at the fundamentals here and we look out the projections over the next few years, these guys ain't making money anytime soon. Their revenues are going up. That's all good. So how do you value that? You know, and the answer is it's very hard. If you look at the analyst recommendations on the name, it's pretty widely covered. There's 19 coverage on it, 13 buys and holds. The average target is $54, and you would say 26. Larry, it's a no-brainer. This is not a no-brainer. If you read some of these analyst reports on how they value the stock, you would just pull your hair out. But so what did I do today? So I looked at my option and my yield portfolio. I looked at this and I said, wow, I could write a 20 put and get 60 cents for it. Wow, isn't that cool? So I'm going to just show you my trading blotter here today, and you can see where is, oh, they're off the book for, no, are they there today? No, they're off the book for, let me grab the history here. There. So plug, we wrote a 21 put and I got 70 cents for it. So I'm going to earn, based on buying it at 21, about 3.5% between now and May 21st. And I get to buy it at 21. If not, I'm earning 3.5%. I'm earning 70 cents, guys. Wow, blow me away. The volatility on this name is 100. I'm writing at 100 vol. That's an incredible yield that I'm earning, and I get to buy it at 21. So what does 21 mean? And I look at it and I say, when was the last time it was 21? Well, the reason I picked 21, there's Pfizer Day. Where did it close on Pfizer Day? $20.30. So my inclination was, before all the speculation began, that we would probably go back to Pfizer Day. And that's why I picked 21, and I'm going to earn 3.5% in my yield fund for the next 3 weeks, 4 weeks, while I'm waiting to buy it at the level that I think is pretty good. Remember, $56 price target, but who knows? Anyways, let me take a couple more questions here. My take on clean energy, right? So again, it's the same chart, guys. Plug and ICLN, that's the same chart, right? So where do you buy this? I've been nibbling here. I've been adding to it. I like it. You know, if we look at plug is 3.8% of it. The Vestas wind is 7.9 and so forth. So, you know, I love the space. If we look at puts, for those of you who can do this, I love generating yield, waiting to buy things at a price that I want to own it at. And it's at 24 today, and I can get for sure 20 cents to buy it at 22. So about 8 or 9% lower than it is today, and pick up a 1% yield. I would do that all day until I bought it. If you bought it today at 24.05, you could reduce your cost. You could write a 25 call for 50 cents. You could write a 26 call for 25 cents. You'll probably get it done at 30. So you can pull in a more than 1% yield, buy it today, and do a covered call on it. So I love the sector. I think there's lots of interesting ways to do it. Folks, it's 8:30. I didn't get through all the questions again. I apologize, but I went deep on a lot of ideas here and a lot of names. I love to show you guys what's behind my thought process and how you guys can probably do some of these things yourself. In any case, please, if you can, support one of our charities, leukemia research at the Sick Kids Hospital and dementia and Alzheimer's research at the Baycrest Hospital, both two world-leading institutions based right here in Toronto that service not only all of Canada, but really all of the world in the groundbreaking research that they do at these great areas that we're supporting. So if you can, Jared and I will be thrilled to match it. And if you are interested in learning more about one of our affiliated companies here, please have a look at some of these websites. Thanks, everybody. Have a great week. We'll see you next week.